Good evening, esteemed members. I welcome you all for this study circle meeting on the subject investment analysis and financial planning. To develop upon this, we have CA Kuppa Setty with us. I request CA Manjunath sir, Chairman of Bangalore branch, to escort the speaker on the dais and welcome with the flower bouquet. Thank you, Chairman sir. I have privilege in introducing today's speaker, CA Kuppa Narasimha Setty sir. He is a BCom graduate and fellow member of ICI. He became the member of ICI and holding the certificate of practice since August 1999. He became the fellow member of Institute of Chartered Accountants of India in November 2004. He is the resource person at the Direct Tax Regional Training Institute, Bangalore, Corporation Bank Staff Training Center, Bangalore, Institute of Chartered Accountants of India for Investor Awareness Program, organized jointly with the Minister of Corporate Affairs, Corporate Coach for Financial Planning. With a brief introduction, I present before you CA Kuppa Narasimha Setty sir. Before handing over, I have a couple of announcements for the upcoming events. On 16th April, study circle meeting on SME, IPO and funding, new regulation. Speaker CAS Prabhudev Aradhya sir, the past chairman of Bangalore branch. On 3rd April, the topic is fundamental to funding and explainer on how startup finance works. Speaker is CA Anjan Babu sir. On 30th of April, the topic is ITC simplified from theory to practice. Speaker is Suresh JW. Over to this sir.
So it is not only having money, you should know how to invest, how to manage money. Money, it is easy to earn but difficult to save. Easy to spend but difficult to invest. If I tell to spend, happily you will spend, but if I tell the same amount to invest, you will not. You will think 10 times. But why is it? Mainly we think safe and risk. If I want to invest, most of the times I will take whether it is safety or it is risky. What is safe and what is risk? Safety is whether I am going to hold the investment or lose. If it is so, how much? And if there is no problem of investment but liquidity, whenever I want to have, whether I will be able to get or not. Risk, safety. Okay. Yeah. Most of us would have invested in fixed deposit. Is it safety or risky? Safety, right? Yes. Now I wanted you to go through this. Fixed deposit, if it is invested for 1 year, it is safety. But if it is invested for 10 years, it is risky. Why is it? Opportunity. It is real rate of return. What is real rate of return? Inflation. In 1984, 1 lakh. Now it is worth of, in 2020 it is worth of 5,100. So if whatever the investment you do it, if which is not growing higher than the inflation, it is risky. What to do? You have to save, invest, earn forever, make your money to earn. We can earn till the age of 58 or 60 years, but afterwards our money should earn for us. How to plan? First we should know why we have to invest and how much and when. So these are the basic requirements for what are the reasons we are investing. If you leave all 6, but if you don't do this, then it is a danger. When you are not earning, you should have corpus. So if you don't plan for anything, you should plan at least for retirement. How to plan? So there are different rules like 50, 30, 50 for essentials, 30 for financial like house, car, all those things. Then balance investment. There is one more thing. 30, 30, 40. 30 for basic needs, 30 for wants, and another 40% for investment. Then, before investing, what are the things we have to consider? Compare other alternatives. If you are planning to invest in one instrument, you should see what are other alternatives. And don't be greedy. This is very important. Whenever any investor comes, and if we ask what is the expected return here, sir, in 1 year I should get double. So if that is the case, in 1 year there are chances of losing the entire amount also. So we should not be greedy. We should always consider what is the normal rate. Like if you are looking at FD rate 8%, you should see what is the maximum. You can expect 12%, 15% or like that. If you are expecting 50% to 100%, definitely the chances of losing are more. Then don't throw all eggs in one basket. Don't put everything in only one kind of instruments. Diversify. Then you have to check the taxation also. Even if you get higher return, if the tax is more on that, which may be lower than other investment option. This most of us and our clients do this. Everybody will try to invest in insurance. Insurance is not meant for investment. That we can discuss. We'll discuss in another slide. And before doing, understand what is the risk. Whether you are able to take the risk up to 5% of investment, 10%, 20%. Based on that, you have to choose the instruments and take the professional's advice. Track the past track records at least 3 to 5 years before investing. And after all, very important, you have to review regularly. Just investing and forgetting after 5 years, 10 years, if you are looking, then it will be a problem. You have to review regularly based on your size of investment. If the investment amount is very small, at least once in a year you have to review. If the amount is very huge, at least once in a month you should review. And this is regarding insurance. Most of us will go for the normal traditional insurance plans and we are under-insured. How to take the insurance? At least 10 times of our annual income. If the insured person is at the younger age like 25-30 years age, they should take instead of 10 times 20 times because their salary or revenue will grow up once they cross 40 years. Why we have to take 10 times? If something happened to the insured, the family will get 10 times of his annual income so that whatever the salary he used to get, they can have the same income with that 10 times of annual income corpus. And if the 10 times of annual income corpus is not able to cover at least 5 times, because when the insured is not there, the family can manage with 50 or 70% of the total expenditure. And if you go for the normal traditional plans, it is not possible to insure for 10 times. Because the premium will be like, if I want to cover 1 crore insurance, I may need to, if I go to the traditional policies, my premium should be 2 lakhs or 3 lakhs per annum. That is impractical. And what are the options available in insurance? Endowment plans or normal traditional plans, their rate of return will be around 6.5%. Insurance unit plans, unit linked insurance plans, which are similar to the mutual funds but differ in couple of expenses. In the units, expenses will be like around 5 to 10% of the amount invested. Whereas in mutual funds, the charges are like 1 to 1.5%. And in ULIPs, you need to pay at least 5 annual installments or 5 years you need to invest. Whereas in mutual funds, you need not to invest so many times. Whenever you have surplus, you can invest, you can stop also. Third difference between mutual funds and ULIPs, after like if the term is 5 years, minimum payment term. After 2 years, if you are not able to pay or you have some other commitments, Then if you want to withdraw, 70 to 80% of your premium will go off. Balance only you will receive. Then the important thing is term plan. To cover 10 times of annual income, we have to go only with term plan. What is term plan? So if the insured is alive, he will get nothing. It is purely as expenditure. If something happened to the insured, the family will get the coverage. But whereas here for the average 40 years person to cover 1 crore premium may be around 30,000 or 25,000 per year. Whereas if you go to the traditional plans, it may be like 3 to 4 lakhs per annum. And nowadays it is a very popular guaranteed term plan. A guaranteed income plan, not term plan. What is it? Like if you invest like every year particular amount, maybe 1 lakh per year, if you invest 10 years and after gap of 1 year from the 11th year, they will keep paying you. It is more popular, but most of the times this plan is sold as it is missold, not sold. Because if you ask anyone, the IRR on this plan is 6.5%, not more than 6.5%, it will be 6 to 6.5%. Any investment which is locked for 10 to 20 years, if you are investing at an IRR of 6%, it is not worth. Your investment is grown lesser than the inflation.
One more thing, you want to go for insurance plan. Because insurance also cost is important.
Yes.
They will agree to segregate both the insurance and investment.
Correct.
Very 60% goes for insurance.
So it is like that. One person's ignorance is an opportunity for another person. That, on that way, most of the insurance plans are sold. If any insurance agent is there, I am sorry.
No, because insurance plans are not for investment purpose.
That is,
Assurance purpose.
sir, I know you know, sir, but if you ask in this hall only, 50% would have invested in insurance.
It is assurance purpose. Accepted.
Because that's what ignorance of one person is opportunity of another person.
Because cost is important.
Yes. It is like for a housing loan, we normally take EMI. If you take EMI, we are controlled with the rupee, by the rupee. And if you have invested, we will control the rupee. This is an example. It might help you and your clients. If you have taken a housing loan, in this example, housing loan is 10 lakhs. Monthly EMI is 9,300. Let us take 10,000 as EMI. And in the total interest payable for 20 years is 12,37,000. When the 10 lakhs housing loan is taken, if the person takes 0.1% of the housing loan as a SIP, in this case for 10 lakhs, SIP amount is 1,000 rupees. If you invest 1,000 rupees for 20 years, that is the tenure of the housing loan, he will recover entire interest paid by him. Assuming the rate of return is 15%. But the big question is it possible 15%? For the 20 years, it is highly possible because if you see last 20 years, return on Sensex itself 16%, whereas well-managed mutual funds given 20+%.
Depends upon market conditions.
So market conditions are only temporary, but in a longer term, definitely it will grow. If not, okay. In this example, we are taking 15%, but if not 15%, then what? See, our cost is 9.5%. If our investment grows higher than 9.5%, definitely we will not lose. So, in 20 years, definitely we will get much higher than that. So, whoever takes housing loan, please advise them to take 0.1%. It is not much. Okay. And one more thing, whenever taking housing loan, most of the bankers will insist to take insurance plan. Is it necessary to take or not? It is necessary. Even if you have some other insurance plans also, like if, for example, I have 1 crore term plan and I took housing loan, still I have to take the insurance. Why? Because that 1 crore term plan, what I have taken based on other needs. But when I took 50 lakhs or 1 crore as a housing loan, now this is an additional liability. If something happens to the insurer, the amount they will get, the insurance amount will get, housing loan get adjusted with the insurance policy amount. The balance, if anything left out, they will repay to the family. But here I wanted to share my own experience. In 2000, somewhere 12-13, we have taken housing loan with SBI for 30 lakhs. The housing loan has been allotted, and afterwards they sent us to the insurance department. So we have to cover for the entire 20 years of tenure. So then one more advantage is they will give loan for the insurance also. So the insurance amount comes to 1,80,000 for the 20 years term. Then what we have to do? Because when we are taking a housing loan, we would have burdened with so many other commitments. Then we were not ready to go for that such higher amount. Even though we get the loan, because the loan is around 9.5 or 10%, let us assume for the simplicity 10%. And the premium what they said is 1,80,000. So if I take 10% on 1,80,000, it is 18,000. 18,000 I will be paying interest apart from the cost of 1,80,000. So then I decided to go for term plan. Most of the private companies, private banks may not agree for this, but SBI has agreed. Then when we took the term plan, they rejected because the premium became less than 5,000 for the coverage of 30 lakhs. Then I told them, okay, make it 40 lakhs, so the premium becomes higher than 5,000 per year. Then they have agreed and they made 40 lakhs as a premium coverage, insurance coverage, and they have given. So instead of paying 1,80,000 plus 18,000 interest every year, just with 5,000 plus GST, I have managed the housing loan insurance. And after taking the housing loan insurance, we should assign it. If it is taken by somebody from somebody else, like if I taken housing loan from SBI, if I took housing insurance from the ICICI, we should make an assignment. Otherwise, it will be a normal insurance. So when it is assigned to that, so if something happened to the insured, first funds will go to the housing loan amount, balance if anything there, then it will be sent to the fund. Then again housing loan. Many of our clients used to ask us, is it right to prepay the housing loan or not? What is your suggestion? Because see, when we have taken loan, we will have some like mental tension, loan is there, loan is there. So to reduce that, people want to repay it. But my suggestion is no. Because housing loan is the cheapest loan we will get in the world. So the loan interest is like 8 or 9%, or even if you consider 10%. And instead of prepaying, if you invest somewhere else, definitely you will get much higher than the interest.
What happens is, you repay the loan, you are eligible to take further loan. You take 30 lakhs loan in 2030, you repay in 2030 30 lakhs. You can take 1 crore rupees loan. You will calculate 40% of your salary and all those.
No, but what is the purpose? Why are you taking loan?
Yeah,
If you are buying some other house, fine.
Yes.
Otherwise, just like that, you cannot take loan.
Cannot be
And
met.
then that is fine because you are going for higher commitment.
Higher commitment.
Then it is fine. Otherwise, if you have surplus funds, instead of investing, if you are going to prepay the loan, you will be saving 8.5 or 9%. But if you are investing, definitely you will get much higher return. So always we need to cost benefit analysis. If the cost is lesser than the benefit, we should invest. If the benefit is lesser than the cost, we should not invest.
And also you have to take your taxation into account. Taxation
Yeah,
is very
now because of the new tax regime, the housing loan that may go.
These are all good, strict.
And this is Sukanya Samriddhi Yojana. I will be covering as much as possible the number of schemes. So here this mainly meant for the people who are not financially educated. It is not good for the financially educated people because if you see here, the rate of return from 9.1 it came to almost 8% now. So when you are investing some amount, you will have some assumption if it is growing at this I will get some amount and all. If there is a difference in like this, then the goal might change. And this, any investments lasted for longer period, like more than 5 years, we should not go for the lesser returns.
So, but Sukanya Samruddhi is tax free, sir?
Sorry?
Sukanya Samruddhi is tax free?
Tax
This
free.
is PPF type.
Tax free.
But then
No, see, regarding taxation is different. See, now the tax is like, if you are gaining 10% tax, instead of 8%, if you are gaining 12%, what is the tax on 12%? Normally all long-term capital gain is now 12.5%. Even 2% goes also, you will be gaining 10%, which is much higher than this, 2% additional. And we will be seeing 1 or 2% difference for the longer term, how much impact will be there. NPS, National Pension Scheme. Type 1 is non-withdrawable. You can take benefit under section 80 CCD. Type 2 is like a current account. You can invest anytime, you can withdraw anytime. But is it advisable to invest or not? As per my understanding, if you are taking the benefit, then you invest. Otherwise, no. Because this is not a liquid investment. You cannot withdraw till you attain the age of 60 years. Let us assume you are 50 years now, you have invested here. After 2 years, you went for bigger house or some other commitment. If you want to withdraw, you cannot withdraw. Even though you have the money, you cannot take loan also. So you cannot withdraw until you attain the age of 60 years. And after 60 years also, you can withdraw only 60%, balance 40%, you have to buy the annuity. There is no other alternative.
60 years or 58 years?
60.
16.
Type 2 is withdrawable.
Yeah, type 2 is like a current account. You can invest anytime, you can withdraw anytime. There is no lock.
Tax will be for the time.
Yeah, there is no.
EDCC will not.
No, only this. Only tier 1.
Just one question.
Yes.
So in that case, for the tier 2, the person should not actually be investing because it's similar to what you invest in the normal market
Yes.
mutual funds.
Yes.
So there is no use for the
There is no
tier
use.
one.
There is no use.
Sir, if we have to compare between PF and NPS for tier 1,
Okay.
then
Sir, regarding the PF and NPS, that I am not aware because there are some other parameters. But regarding the PF and with other investments, I will have a comparison. That will hold good to the NPS. And one more thing, if you are investing in a normal investment, you can decide whether you can go for 100% equity or 30% equity or 20% equity. You can decide. Whereas in NPS, based on your age, it will only decide like once you cross 50, they will reduce the equity component. So because of that, at the end of the 60 years, the growth may be lesser.
It's a basket of all those things.
Yes.
so buying annuity I understand.
Annuity. See, it is a pension. See, the purpose is National Pension Scheme. So the purpose is to get a pension. So after the attaining your retirement, because it is a pension scheme, you have to buy the annuity. There is no other option.
We installment will get.
Yes, monthly pension you will get. See, like so before investing, you can just have a look at this rule 72. What is rule 72? Just to understand how many years it will take your money to double. For example, if the instrument is having 8% return, it will take 9 years to double. We can see next slide. It is another. See, if the return on investment is 20%, it will take 4 years to double your money. If the return is only 2%, it will take 36 years to double your money. Just to have how much you are going to get. And this is tripling 3 times. So it is there, we used to do 72 divided by rate of return. Here 114 divided by rate of return. If it is 8%, if you do 114 divided by 8, you will get within how many years your money will triple. What are the investment opportunities available? FDs, corporate deposits, Postal savings schemes like Kisan Vikas Patra, NSC, all those things. EPF, Employee Provident Funds, PPF, Public Provident Fund, capital gain funds when you have the capital gain amount. Senior citizen schemes. This is also applicable for the people who are above 60 years. The advantage of this is for 5 years they will get same rate of return and the rate will be little higher, 8% or 8.2%, 8.5% like that. But for 5 years they will get the same return. They will not, bank will not change in rate. NPS we have already discussed, Sukanya Samriddhi also we have discussed. Then these are other alternatives, mutual fund, shares, PMS, portfolio management services. It is like similar to mutual funds, but mutual funds will have, you can invest even 500 rupees also. But to invest in PMS, you should have at least 50 lakhs. And it is locked in, you cannot withdraw as and when you require. Another one is alternative investment funds. Most of the AIFs can be invested by HNIs because their minimum investment is 1 crore. Market linked debentures or Nifty linked debentures. It is a different kind of product. It is like a guarantee. Your money will be safe, irrespective of the market condition. Here, for example, if you are investing 1 lakh, let us assume it is 2 years product or 3 years product. Let us assume it is 2 years product, and whatever it will be divided into 2, debt product as well as options. If you are investing 1 lakh, assuming rate of return is 10%, at the end of 2 years, to get 1 lakh, how much should be invested? They will work out like 1 lakh divided by 1.1, that is for 1 year, divided by again 1.1, that will be by second year. So if they invest, for example, it is 85,000. So they will invest in the safer investments, fixed income bearing investments. So this 85 rupees will be 1 lakh after 2 years, that is at the date of maturity. That balance 15 rupees, they will invest in the options for a longer period, like 2 years option they will buy. The options are linked to the market. If the market goes up, this options price will go up. At the end, this 1 lakh plus options amount they will get. In case market went down, so you will get at least 1 lakh. So even for NLD and MLD also, it will be either linked to the market, that is Nifty or Sensex, or it can be linked to the particular share, like Reliance NLD or Infosys NLD, like that. And commodities like gold, silver, precious metals or jewelers. Then derivatives, options and futures, this will be discussed. So derivatives. Most of the investors in the derivatives, or 95% of the investors in the derivatives will lose money. Only 5% of the intelligent investors, which for them we can call them as a professionals, only they will make money. The purpose of derivatives, may I know what is the purpose of derivatives? Any idea? It is mainly to hedge. Like if I have a 1 lakh of 1 crore portfolio, in case if the market goes down, I don't want to lose my 1 crore principal. So then I will take the derivatives option reverse. Like if I am holding 1 crore, I will sell 1 crore value of the either in futures or options. So that if the market goes down, my futures or options value go up, so that I will not lose anything. That is the purpose. But most of the small investors are misusing it and losing money. One of my friend, overnight he has lost 16 lakhs in one particular share. So that is the risk of derivatives. Investing in gold. Most popular question nowadays. That took particularly last couple of months. In 1979, gold was 937 rupees. In 2017, 28,360. What is now the value? 90,000 plus. See, 900 rupees becomes 90,000. What is the growth? So that is gold. At the same time, Sensex in 1979, 100 rupees. In 2017, it became 31,000. Now what is it? 74,000. So 100 became 74. 900 became 90,000. So that is the comparison between investing in gold and investing in equities. But whether to invest in gold or not. See, gold is a commodity. It is meant for consumption. If you want to buy gold, don't go for gold bonds or biscuits. Buy jewelry, give it to your wife. They are also happy. For you also, it is investment.
No, Kuppa. Buy the gold and buy the jewelry. You are paying GST.
Yes, sir.
You are
One thing.
paying
Yeah, I got your point. But what is the difference buying gold jewelry? See, one is 10 to 15% making charges and 3% GST. And maximum 20% that is considered. Sir? Yeah, that's what sir. See, altogether it may not cross more than 20%. See, when you buy a jewelry, for how many years you will be holding? It will be there for generations, not for 1 year or 2 years.
Actually, the taste will change every year. The next year they never use the same gold. What is the replacement? Again, making charges.
No, sir. If that is the case, it is not advisable.
Jewelry is not investment. You take
It is
the
only for consumption.
Yes, sir. That's what, because earlier, if the jewelry is there, it used to keep on generations. It used to pass on for generations.
old generation jewelry, most of the new generation people are not using.
Yes. So if that is the case, not advisable. Imitation jewelry is best.
Ornaments are not advisable.
Yes. But yes.
Because if you buy the gold bonds or other things, there is
Sir, that's what I say. When you are buying bonds, it is not for consumption. It is an investment. So when if it is an investment, you consider 100 becoming 31,000 or 938 becoming 28,000.
Okay.
So you should be clear what you want. You want investment or consumption. If it is investment, don't think of gold only. But your view will change after seeing next slide. Okay, this is comparison of various investments for last 44 years, 1981 to March 25. We'll go to the next slide. Next. So, next. Okay. For 44 years, 10,000 invested in 1981. Gold became 10,000, 5,53,000. Silver became 3,83,000. FD became 3,89,000. TPF became 5,57,000. Whereas Sensex became 44 lakhs, almost 45 lakhs. Now you decide whether you want to invest in gold or invest in somewhere else.
Based upon you are taking out as sense of based on particular particular cash base.
Yes. Next.
Any reason real estate is not featuring in any of these slides?
Sorry, sir.
Any reason real estate is not featuring in any of these slides? No, I'm asking, is there any intention that you haven't factored the real estate as the investment option?
No, real estate I have. Because real estate is also, I feel it is not meant for investment. Because if you buy a land in Jayanagar, that will not yield much. You have to buy it somewhere at Devnali. But if you buy there, you cannot carry the cost because somebody will come and occupy. That is one thing. And second thing, like it is not easily transferable. To sell, like when you want to sell, buyer will ask for lesser rate. When buyer asks, you will quote higher rate. So, as an investment real estate, I don't advise.
No, in stamp duty also there.
That is 7%. See, normally when we have the real estate, it can be hold for 10 years, 20 years like that. So at that time, stamp duty becomes marginal, very less. See, so this is a chart of all other investments. Yes, sir.
But Sensex can become zero also depending on what you share.
It cannot be sir. Because you tell me what is there in Sensex? All companies. See, Sensex is only 30 companies. It is like a ABC analysis. Like all shares, around 5,000 shares are there. All put together, if the value is 100 rupees, this 30 shares value is 70 rupees. That is 70% of the entire market is of this 30 shares. And what is that? Companies. Can any company run for charity? No. Can any company run for losses? Yes, for 1 or 2 years. If continuous losses are there, what they will do? Either they will reduce the cost or they will increase the sales price. So they will become into profits. So when they turn into profit, will it become zero? No. See, temporarily Sensex may go down, but longer term, because you are investing into the businesses, you are not investing into a some instrument. So every business is tend to grow. Are there any chances of going vanishing? Yes, we have seen Satyam, we have seen Yes Bank, but how many out of 5,000, maybe 10 we would have seen. And this Sensex is not same what was there 30 years back, because the companies are keep getting changed. If the company is lesser than their parameters, it will go out and some other company will get ahead. Okay. Okay, this is impact on Trump tariffs, recent changes, like how it has impacted. India is least affected, one of the least affected country because of the Trump actions. If you see equities, USA, their own country fell by 12%, whereas India fell by only 3.3%. Whereas currencies, INR strong, commodities, all fell down. So, but it is a temporary phenomena. Everything, any problem will overcome over a period of time. It may be sometimes months, sometimes weeks, sometimes even 6 months also. So, Sensex becoming zero. See, it has started here. It went down so many times. It keep on went, rebounds down. See, like even recent also, it may go down, but it will not become zero, because you cannot expect all the companies to become zero. If it is the case, we also cannot practice. And regarding gold, we need to change our view here. If you see 10 years, this is as on March 2024. If you see last 10 years, we have seen 40 years, 50 years like that. But if you see last 10 years, gold is grown by almost 9%, whereas Nifty grown by 13%. But see here, if it is 5 years, still it is 24. Now the value got changed. If it is 5 years, gold has grown by 16%, whereas Nifty grown by 14%. But if you see here, whenever troublesome, like it is 2008, gold has gone up, equity came down, and like it is 2020, market came down, gold gone up. Whenever there are turbulences, at that time gold will go up. If you observe between 2010 to 20 somewhere, for 1 decade, gold has not grown anything. It was there around 26,000 to 30,000. And I am just comparing, it is as on December. This is the gold funds. You can invest gold through the mutual funds also. This is the data of investment. Gold fund, 10,000 invested, it became, number of times it is almost 3 times it grown up. Whereas if you see some other equity mutual funds, it has grown up almost 10 times. That is the difference. Higher the risk, higher the return. Somebody were asking for PPF, no? PF or PPF. Like this is an example. See, actually we cannot compare tax saver to PPF because both are different risk. We can say like oranges to be compared with oranges, but ultimately we are investing money. When we are investing, we have to see other alternatives. As per SEBI, we are not supposed to compare this kind of comparison. In this example, this is as in 2023. One investor invested 1 lakh every year from 96 to 23, 1 lakh. If it is invested in PPF, this is the value. And if it is invested in a tax saver, this is the value. Can you just read out what is the value here and here?
9.2 crore.
This is 99 lakhs, it is 9.3 crores. That is the difference, taking the risk. Where is the difference? 10 times in this period. You can just read out here. PPF became sorry, it is ELSS become 9.27 crore. Whereas the same amount in PPF, it is around 99 lakhs. If it is a longer period, if you are looking for 10 years, 20 years, close your eyes and invest in equities. We have seen first slide, FD invested for 10 years, it is very same. And investment in mutual funds. See, most of us may not be so easy to invest in equities because we will be busy in our own profession to attend the clients and all those things. Whereas, if we invest in equities, if it is small amount, fine. If it is higher amount, our concentration will be on equity or Sensex, not on the clients or the works to be completed. So the other alternative is invest in mutual funds. What is the advantage? We need not to monitor first thing. It is a diversification. There is a professional who will take care of the management. Affordability. How much ever you want, you can even invest 500 rupees, you can even invest 5 crore. Liquidity. Whenever you want, you can withdraw it. It will take 2 working days to withdraw. Like if it is, if you are redeeming today, within 2 days you will get back your money. Transparency. You can see your valuation on every day. And tax advantage. So how you can invest in mutual funds? Lump sum, one time. If you have some like 1 lakh, 10 lakh, 5 lakhs, we can invest one time. And if I want to invest 5 lakhs, but I don't have money, but I will have regular cash flow, then I will plan SIP, systematic investment plan, like monthly 5,000, 10,000. You can even start with 100 rupees now. Micro SIP it is called. Then SIP. I have lump sum amount, but I don't want to invest at this higher risk market. Because every day it is down by 2%, next day it is up by 1% or 3%. So I don't want to invest. Then you can invest in a safer investment, it is called debt investments. From there you can do systematic transfer plan. You can transfer either daily, weekly, monthly, fortnightly. And SWP, reversal of SIP. Like till you keep earning, you can invest. Once you take retirement, you can use this systematic withdrawal plan. You need not to withdraw entire amount. You want monthly 50,000, you can give one instruction. Every month, amount will get redeemed from your investment and will come to your bank account. What are the requirements? Should have PAN, bank account, and Aadhaar also. If any small investor is there, if they don't have PAN, with Aadhaar they can invest. Address proof. If it is an investment in minor, major parents or guardian documents are required. These are 2 basic types of funds: equity fund, debt funds. Equity funds, more than 65%, they will invest in equity shares of various companies. And if it is a debt fund, they will invest in the corporate bonds, government bonds, like that. Different categories are there. And this is a combination of equity and debt, hybrid fund or balanced funds we call. There may be like equity oriented balanced funds or debt oriented balanced funds. Apart from that balanced funds, we have capital protection fund. We have discussed about market linked debentures, similar concept, capital protection funds. Then ETF, exchange traded funds. There to buy ETFs you should have a demat account. For other mutual funds you need not to have a demat account. And gold funds. If you don't want to take a physical gold, you can invest through gold mutual funds. So these are different categories of balanced funds or hybrid funds. Okay. Then you are investing in any mutual funds. On what basis are you going to invest? Generally it is past performance. Last 5 years it has given 20% return. Blindly invest. But how to be invested? Because winners keep rotating. Every fund cannot be there for continuously. They keep rotating. After you invest, that fund will underperform. So then what is the remedy? First, before investing anywhere, first you have to find out for what purpose you are investing. Is it short term or long term? Like if you are investing for the tuition fees of your children, which is to be paid next year, then you have to choose different fund. If you are investing which is required after 10 years, you need to choose different fund. So first you have to decide what is the goal and investment horizon, then risk appetite. If it is going down, till what extent you can digest the risk. Then apart from all these things, portfolio of the fund, where the fund has been, that particular mutual fund has been invested. Because your future returns will not come based on the past performance, based on the portfolio, your future returns are dependent. Nowadays, this is very important. Expense ratio matters. What is expense ratio? Like any mutual fund, there are two categories of mutual funds: direct mutual funds and regular mutual funds. What is the difference? Here, no intermediary is involved. No mutual fund distributor or no bank. You are directly buying from the mutual funds. Sorry, here indirect mutual funds. Whereas in regular funds, there are some intermediary, professional advisors or mutual fund distributors or banks are there. So when they are there, they will be devoting their time. For that, they will be charging. So they will not charge you directly. Mutual fund company will pay to them as a commission or brokerage. Then there will be a difference in the return. Normally in the equity funds, the difference may be around 0.5% to 1 or some, in some very few cases 1.5% also might be there. So whether this expense ratio matters when you are investing. See, all of us are chartered accountants. A client comes, asks you to file the return. You will be filing and you will be charging. But if the client can file on his own? Yes. Is there any value addition when he files or when you file? That is the difference between direct and regular. When he files, even though he would have read everything, he would have understood and he would have filed as good as we file. But what is the time he has devoted for that? If he has devoted that time to his business or his job, he would have earned much more than that. So that is the difference between direct and regular. And index funds. This is the most, like if you see any social media, they will advise to invest in index funds because lesser charges. It is miscommunication because see people also they will see the reel is very good. Yes, I need to save 1%. I will invest in index funds. That is a general. We will see what we are saving. We are not going to see in future what we are losing. We can see here. This is again as on 19th December. First two are index funds. These funds will grow according to the index. If they
The previous slide,
previously
can you use the same concept for shares also?
shares, there is no direct. You have to buy through broker only.
Demat account?
Yeah. Yeah.
Demat account, yeah.
Yeah, you have to buy through Demat account. You should have some broker, and if you go to Zerodha or Grow app, some apps like that, the charges are very less compared to if you go to ICICI Direct. Brokers will be high.
But regular was a professional investor who has been to.
No, for shares it will not apply. It will apply only for mutual funds.
So that means to say that we should go in for regular mutual funds rather than direct.
Yeah, I suggest regular mutual funds.
But finally the expenses will be
Madam, what is the expense ratio, madam? How much you will be saving? 1% maximum or 1.5% better than. You cannot save more than 1.5% through direct funds. Okay, but if you see social media for 20 years, this you would have been saved 27 lakhs, 30 lakhs. That is there, but that is all myth because you will not keep your investment for 30 years. You definitely will break because out of 100 investors, only 1 or 2 investors are there for 20 years. Most of the times you will come out, and if you see whatever the people they have recommended for direct plans, 90% of them have stopped investing or reduced investing because mis-selling, misconceptions, everything will come.
And that
Because
is
I
where
was I was of the impression that direct mutual funds is more beneficial.
No, more beneficial, but the thing is like no, the assessee filing return himself
Got it.
and getting it filed by the chartered accountant. Is there any difference?
Then-
He would have read everything, entire act, how to file everything. But what is the cost?
Correct.
See, to save 1%, you have to devote some time. If we devote in some other, in our profession, we will earn much more than that.
Got it. Thank you.
See, whoever has to do which job, they have to do it.
So I think my experience has been the same thing what you're saying, that while people say that you lose 0.5 or 1% by going through the direct, through the regular, but then eventually you do the miscalculation, or sometimes you invest in the funds for which the portfolio is not going to grow or will go down. So, and that's where you tend to lose more than gain,
Yes.
because sometimes what you lose will be 5%, so the opportunity
To
cost
save
will be
1%, you will be losing 5% and it is compounding.
Yeah, it's compounding.
And because now to realize that fund is not performing, it will take 2-3 years. Because most of the times, the people who are using the social media, 90% of them are attracted to the direct funds. And like now, how you are attracted for direct funds, same way you will attract for funds. So poor funds, they would have suggested. But if it is invested through a professional or some intermediary, like no, they cannot just suggest like that. They will assess you, what is your requirement. See, it is like this. I am a pure vegetarian. It will show non-veg and vegetarian hotel. It will give advertisement. It is very cheap. But I cannot go for that. If I want to have only pure vegetarian, I should select only pure veg hotel, not the veg hotel. And if I am non-vegetarian, I cannot go for vegetarian hotel. Same way it will be. It is only miscommunication. But people know, if you save, you are going to save 1%, you will attract. But you will not recognize that in future you are going to lose. But the same fund, if it is gone through the advisor, if he comes to know something, the scheme is not performing, he will intimate you, whether this fund is not doing better, it is not doing well, it is better to change the fund. But if you are doing on direct, nobody is there to suggest you. And there is no free lunch. You cannot expect professionalism with free. So when you are investing in my experience, the people who are investing 5,000, 10,000 or up to 1 lakh, they are attracted for direct funds. But people who are investing in crores like 5 crores, 10 crores, they are doing through the advisors. Because they don't want to take the risk. They are ready to pay for the service. And one more thing, the advisors, they keep on interacting with the fund managers. They keep on reviewing the portfolio of the fund, valuations of the fund. If it is not performing well, they will analyze this is with temporary reasons or permanent reasons. If it is a temporary reason like market is down, then they are not worried. But if it is with permanent reasons like fund manager changed, some manipulation happened, something happened, then they will advise you to shift the fund. That is the main advantage.
Okay, I have a question. So, for example, I have two advisors. One advisor is basically rotating the funds after 3-4 years by seeing the market. The other advisor is always saying that keep invested because you will always earn the money, be in the market, don't come out. So, let's say even though something is performing 60% for year on year 15%, even though it is static now, but just keep investing. So they doesn't want to rotate. So I think you would prefer the advisor who is rotating.
Sir,
Right.
both are good on their own because the fund which he has selected, because if it is a balanced fund, let us assume, there is no point to rotate it. If it is an equity fund, when the valuations are very high, it is better to book the profit.
Yeah.
So it is based on the fund in which you have invested.
Okay.
Just like that, you need not to rotate, you need to consider other points. If the market valuations are very high, see, this product is 100 rupees. If it is selling at 150 rupees, what you should do? You should sell and come out. And it comes back to the normal, like it will come to 100 rupees, then you can buy it.
Okay, so the second question is that nowadays a lot of clients basically are willing to go for the investment through us. So in that case, they also have an option to go through the bankers as well, who also are very much aggressively pushing for the investment by saying that you are with the bank, payment, this, like that, and all those things. So what is the kind of the CVP you can tell to the
Sir, my
clients so
personal
that
experience.
they move from bank to you?
Sir, if I have to file the return, you are a chartered accountant, there is one more person, income tax practitioner, to whom I should go.
That's really
To get the good knowledge. See, banker is banker, not the investment manager. See, if you have to do banking, do with banker, not with investment. And one more thing, if it is an investment advisor, he don't have the targets. If it is a banker, they have the targets. So, who are going to lose? And today, some ex-employee is there, tomorrow, Y employee is there. And you will not have a track. And they don't follow up you, like this scheme is not doing well to change. But if it is a mutual fund distributor, because it is bread and butter, he has to do that. Always we should keep investing through the mutual fund advisor. Don't go, I don't suggest to go with the banks.
Okay, and the last question is...
And one more thing, if you go to the bank, first they will push for the insurance. If you are not going to bank, then they will give mutual funds instead of losing the client. Because they look at higher revenue, not the, because in mutual fund, normally mutual fund distributor will get 0.5% to 1%, not more than that. That is the reason you cannot find more mutual fund distributor. Whereas insurance advisor, both of your members would have become insurance advisor because the revenue is 10%, 20%, 50% also.
Oh, thank you. The last...
Again, it's pre-tax, and GST income tax, 50%.
Yes.
Okay, the last question, which is not about how is FD and all those things, I'm not going into that. It's just that quite a few times the advisors are trying to push and say that you don't keep any FD. So I'm not comparing to now where people are saying that FD was good. No, I'm not into that area. I'm saying in general, they always advise that rather than going to the FD, you can go into the various other funds,
Yes.
which could be the arbitrage funds,
Yes.
where the tax benefits are there, and which is what we also tell to our
Sir,
client as well.
Yeah, I got your point. See, if it is FD, what is FD? Fixed deposit. It is fixed for a term, like 3 months, 6 months, 1 year, 2 years. So, let us assume you have invested for 1 year FD. Interest rate is 8%. Okay. But after 2 months, I want some money. Like you have kept 1 lakh FD. You want only 10,000. What is the option? What you have to break the FD. After 2 months, what is the interest rate applicable for 2 months? Instead of 8%, they will give only 3%. And you have to break entire FD of 1 lakh to get 10,000. Or you can take a loan against your FD. If your interest rate is, if you are earning 8%, you have to pay 10%. Whereas if it is a mutual fund, if you want 10,000, you can withdraw only 10,000.
So the benefit part is clear in
Yes.
terms of FD versus the mutual fund,
Yes.
taxations and
Yes.
other complications. But in general, the concept which NOD advisors are always saying that don't keep any
So
money in
you
the
have
FD.
seen in the first slide.
Yeah.
Don't throw all eggs in one basket.
Yeah, that's a point.
Keep some amount in FD. See, as a portfolio, you can have. See, if you have 10 lakhs, keep 1 lakh as FD. Balance 9 lakhs. See, in another way, any expenditure which is required for next 1 year, you keep in FD. Which is not required for 1 year, keep it in mutual funds. That is the best strategy.
Fine.
Okay. Investing in index fund because it is low cost. See, these first two are index funds which grow according to the market, like Sensex or Nifty. If you see last 5 years, market has grown by 15%. But if you see most of the funds which are almost above 20%. What is the difference? More than 5%. To save 1% or half a percent, you are losing 5%. If you see 1 year, 12%, 20, 30. But in any case, it cannot be. In most of the, see, 1 or 2 cases might be there lesser than the or equivalent to the returns. But if any such underperforming funds are there, you can always change it. How to become crorepati? Interesting? 15, 15, 15. If you invest 15,000 for 15 years per month, if the funds grows by 15%, it becomes 1 crore. 15 years, 15,000 per month. growing at 15% rate. It becomes 1 crore. In case lesser than 15%, what happens? Little lesser than. This is one example, the power of compounding. Like it is good for the children plans. If you keep investing 1,000 per month for 39 years, 1,000 per month for 39 years, if the rate of return is 8%, how much it becomes? Almost 32 lakhs. You are investing 4,67,000, it becomes 32 lakhs. If the instead of growth is 8%, 10%, what is the value? 56 lakhs. If it is growing at 12%, it is 1 crore 3 lakhs.
39 years.
39 years. It is just 1,000.
Alright.
Yes.
So take it out with
See, this is to understand the power of compounding. See, after a certain period, what you are investing 1,000 is a very, it is negligible amount, but the compounding, what it is growing, that will be much higher. And you can plan like 15, 15, 15. Same way. And starting early, SIP start as 40, stop as 60. Invested 10,000 per month, we got 92 lakhs. Expected return is 12%. Whereas another person even started at 30 age and invested only for 10 years till 40 years, and at the end of at the age of 60, the corpus become 2.16 crores. Higher the period, higher the growth. Lesser the period, lesser the growth. And when this slide is seen, many people will keep repeating, "You have lost the bus." Don't worry, you can educate your children.
Yes.
Okay, this is same. To get 10 crores at the age of 60 years. If you start at the age of 25,000, you need only 15,000 per month. If you start at the age of 30, you need 28,000 per month. If you start at the age of 50, you need almost 1 lakh per month to accumulate 10 crores at the age of 60. Assuming the IRR 12%.
return is constant.
Yes, sir.
Rate of return is constant.
Yeah, this is only workings. And why SIP is good? Market volatility, if you see here between 2015 March to 2017 March, Nifty has grown only 2.42%. Whereas if it is invested through SIP, the return is 15.84% or almost 16%. How it happens? Like when the market goes down, you will be getting higher units, number of units are more. Means you are investing at a lesser rate. When the market is higher, you will be getting at lesser units. So this keep averaging whenever the market, because market cannot be constant. It will keep volatile. You keep investing, so it will average.
So we are saying that everything, but then if you are able to time, so again it's not about timing, means we have to keep a tab of every 1 hour in terms of how the market is going. So one other method which I have learned is that whenever the market will fall, definitely in the best of the case also it will fall once in a month 2 or 3 times, right? Which is what was happening when it was 80,000 also,
Yes.
right? So you decide that you should be available on those days. That will give you more advantage than the average SIP. SIP for those who can't track that kind of thing, which is not we are seeing every hour, but at least once in a month or twice in a month. If you are able to, that has generated more value than the SIP.
Yes.
Because nowadays SIP is a mantra. All the investment gurus and advisors, everyone says that SIP is the thing.
Yes.
But then if you are able to time that in the best of the market, it will average out return more, right? That's the experience.
Yes. See, we normally keep on telling to the investors, if you see your portfolio in red, like minus 10% or minus 20%, that is the best time to add more. Whenever you see negative in your portfolio, that is the best time to add more. And whenever you you feel very high, market valuations are very high, it is advisable to book some profit. Not everything.
Sir, since the comparison based on past data, the last 10-20 years, mutual funds, SAP didn't have so much of knowledge. But now everybody starts investing.
Yes.
So you still think that for future, like SIP based model definitely looks good compared to, especially for someone like in our profession,
Yes.
busy entire time.
Yes.
But going forward, you think that cannot return what 10 years back to now we got?
Fine.
We will continue
Yeah.
because government
Correct.
also is
See,
pushing about it.
how the mutual funds are growing, how the NAV is going up because of their portfolio. Correct? They have invested in ABC shares. Correct? If the shares value of that particular portfolio goes up, your NAV value will go up. Correct? It is nothing but the portfolio is growing up, your value go up. If the portfolio goes down, your value goes down. Correct? And where they are investing? They are invested in businesses. No business, we have discussed, no business are doing for charity or for losses.
No, I am not telling the
No, the same way, because
same, will you see the same growth in the future?
yeah, because till now we have been underdeveloped economy. Now we are developing economy. Till we reach the saturation point, we keep growing much higher rate than this. Because if you see now, the US growth rate is only 2%, but we are growing at 10%. So till we keep growing, definitely we will see that returns.
A few of the conceptual points which you were saying, the one was that when market is low, you should try to book, not the
Low,
high,
you should
invest, and when it is high, you should try to book the profit. Now that also, there is a conflicting views between the advisors.
Yes.
So one, they say that when the market is growing, why would you want to book the profit?
No,
Keep it there so that
that's
you
what I
will
told you.
be-
We should not do 100%. See, normally what I recommend, if the market is grown up, 10% of your portfolio should book. If market goes up, after you book the profit, another 90% is there to take care.
Hmm.
In case if the market comes down, that 10% what you have already booked, you can re-enter.
Okay.
So each time you should not do entire thing. Like if you have done 100% portfolio profit booked, then Sensex rises, then you will be losing that much.
So that means a good point, because the advisors always say that the 10% of or 20% what you book, you will again enter into the high market. So the idea is that we don't need to enter.
Yeah,
We
you
just need
can-
to keep that money separately.
Yes, yes.
And we need to enter when it goes low.
Yes, yes.
That's the concept.
And that's what I see, there will be two moments. One is temporary fall, one is permanent fall. See, for example, during March 2020 when the pandemic happened, it is like as if there is no tomorrow. We don't know when it will be recovered. And that is not a temporary problem, it is a permanent problem because, see, we don't know whether we are alive or not tomorrow. So that is a permanent problem. At that time, you should book more profit. And if it is like now the tariff issue is there, it is a temporary because US cannot survive because if they impose tariff, their costs are going to increase. So their inflation is going up. That is the reason US market is fallen higher than other countries. So they cannot survive because this is temporary. It will take some time, maybe 1 month or 2 months, they will realize, they will come out of this. Like just 2-3 years ago, when the war started, market fell like anything. But that war continued for 3 years. Nothing else. See, when it is, the impact will be very high at that time. So any such cases like higher impact, at that time you can book instead of 10%, 20 or 30% you can book. If it is a normal situation, you need not to book. Valuation you have to see, like Sensex when it touched 86,000, most of the people thought it is unrealistic. So at that time you can book more. If you feel unrealistic, you can book more. Otherwise, now it is, valuations are very cheap. If I tell now to invest, they will laugh at me. At this market you are telling to invest like that. So now this is the investor's mentality.
But why FIs are not reliable in the Indian growth scenario?
Sir, it is not like not reliable. They are relying, but they are taking. See, till the drum comes, their bond yields are high, like 4%. For them, when there is a growth of 2%, 4% is good amount. So that is the reason they came out of, they went out of all emerging markets and they have invested. So now slowly they will come. If you see in the Mars, they came like anything. But now they are not, because they also now are uncertain for their future. So after, see, Definitely when a country growing for 2%, when another country is growing by 8%, 10%, definitely they will invest at the country where the growth is higher. So definitely they will come. But only thing is it may be time. They may be having some other assumptions also. Yes, sir. So, look. See, this is the advertisement of when I saw in 2012. 46 times in 17 years. 10 rupees became 460 plus rupees. The same fund, it is Nippon Growth Fund. Earlier it was Reliance Growth Fund. The same fund in 2022. See here 2012, 22. This 4 lakhs became 20 lakhs. Same 10,000 became 20 lakhs. The same 1,000 on 3/9/2024 it became 41 lakhs. What is the difference here? Only 2 years. When the market went up, within 2 years it became doubled almost. And now if you see as of yesterday, that 41 lakh became 34 lakhs. Same fund. And most of the investors, particularly this kind of market, when the markets are going down, they wanted to stop the SIPs or taking out of money. This is one example, 2010, 11, 11, 12. This is one particular fund, it is Sundaram Small Cap Fund. I will not mention, say, most of the cases we are not supposed to mention the names as per the SEBI. So that is the reason I have not mentioned in some cases. Here, this is the NAV of that particular year. It was at 29 rupees, 27 rupees, 29 rupees. For almost 3 years, there was no growth in the NAV. Many people stopped investing in that fund. But if you see next year, 29 became 45. Then 68, it went on to 99 rupees almost, or 100 rupees. Again, when the market crashed in 2019-20, that 100 rupees became 50 rupees. That is the reason when you feel valuations are very high, it is good to book profit. And the same, this investor has stopped during 2020. The SIPs. At that time, he has invested 1,18,000, market value is 1,26,000. The same fund, as of today, 5,40,000. If he has withdrawn 1,26,000, how much he has lost? There is one more slide similar to that. Cost of impatience. These are the particular funds one investor redeemed during these days. He has redeemed in 2020 2,82,000. The same fund, if it is kept now, it is 7,14,000. It is as in December. Sundaram Small Cap Fund I have given another. See, in 2020 he has withdrawn for 1,83,000. The same fund now the cost is value is 5,22,000. So you should be very patient when you are investing. See, most of the direct funds will take out when the market is not doing good. But if it is with advisor, he will keep hold. You could have got this much. This is the cost of direct and regular.
So for shares, we will come to know by PE whether it is overvalued or not. How
Sir,
to identify mutual
Sir,
fund?
shares you cannot compare, sir, because you see the PE of Infosys, you see the Canara Bank PE.
No, I am not telling that. How to identify it is overvalued or not mutual fund? Because you told you have to redeem when it is overvalued. But how to identify it?
Mutual funds, you need not to see the portfolio or share. You have to see the Sensex PE. If the Sensex PE is around 28 or more than 10 years average, you can assume that the valuations are little costlier. If the PE of Sensex or Nifty lesser than 10 years average, you can consider it is the time to keep investing.
No, sir, I got it there, sir. For mutual fund, out of 2 mutual funds are there. How to identify one mutual fund is overvalued, one is not overvalued?
No, mutual funds you cannot.
You can, because
each fund will have the different portfolio. And the same fund, this month they may have different portfolio, and next month they would have gone out some shares and they would have bought some other shares.
Sir, one more concept of small case came recently. That is also same like mutual funds, sir?
Sir, it is also same like mutual funds, but it is not that much regulated. See, the best thing of mutual fund is it is highly regulated. So investors blindly can invest, trust and invest. Because any other things are not that much highly regulated. So what are the different incomes from the investment?
Mutual funds are full regulated and high returns. Where is the risk for it?
No, risk is only market. In mutual funds, the risk is only market risk, nothing else.
No, market is anyway going to grow, no?
That's what I see. Any mutual funds, there is no other risk involved. Only other risk like front running. Some fund managers may misuse. See, when they want to buy a particular share for this fund, let us assume the share is quoting at 100 rupees. What they will do, they buy first at 100 rupees, high volume. It becomes 1 or 2. Afterwards, mutual fund will buy. So that is the only problem in some of the mutual funds. Some of the funds got the penalty for that. That is called front running. That is one risk, but that risk is very, very minimal. In the mutual fund, risk is only market risk, nothing else.
Now what is market?
Market risk is share market, like Sensex gone down. That is called market risk. See, when you have invested, Sensex was 86,000. Now it is 74,000. This is called market risk.
Out of your company.
Sir?
Out of your company.
Yeah. Next. See, today RBI has reduced the repo rate to 6% from 6.25%. What is the impact? For the equity mutual funds, there is no much impact. But debt mutual funds, if you have invested in debt mutual funds, whenever there is a rate cut, you will get good growth in the debt mutual funds. How? For example, if you have one FD which is yielding 8% return, and tomorrow onwards you got 1 lakh rupees which is going to do 8% return for next 5 years. After this rate cut, tomorrow bank will reduce the FD rates. It will become, instead of 8%, 7.75%. Tomorrow I will go and invest, but I will get only 7.75%. Whereas you are getting 8%. So is there any difference value? This can be worked out like this. 8% divided by 7.75%. The value of your 8% yielding bond can quote at 103 instead of 100 rupees. That is the reason most of the mutual funds will be holding the bonds which are yielding. Whenever the rate cut happens, the yield will go up. That is the reason the growth will be there. But what happens if instead of rate cut, if they increase the rate? It will reverse. It is called interest rate risk. If it is equity, market risk. If it is a debt mutual funds or debt bonds, it is called interest rate risk. In the bonds, again there is one more risk called liquidity risk. For example, when the Yes Bank is taken over by the SBI, there were some bonds. SBI said, we are not going to take those bonds, which became zero. It is called liquidity risk. You cannot sell it. But in equity mutual funds, you will not have that liquidity risk, because most of the mutual funds will invest in the companies where higher liquidity is there. What are the changes? Up to 2018, any capital gain from equity share or equity mutual fund are tax free. Till 31st January 2018, any gain of equity share and equity mutual fund was not taxable. But on 1st February 2018 in budget, they have imposed it is taxable if it is long term 10%, short term 15%. And one more thing is, if you have invested before 31st January 2008, you can get the grandfathering provision. What is grandfathering provision? Like you have invested at 100 rupees, as on 31st January 2018, that 100 rupees share quoting 1000 rupees. And when you are selling now, you are selling at 2000 rupees. What is the actual gain? 2000 minus your cost is 1900 is gain. But if it is invested before 31st January 2018, the market value of 31st January 2018 can be considered as a cost. In this case, 2000 selling price, fair market value on January 2018 is 1000 rupees, only 1000 is taxable. It is called grandfathering.
how that will be identified?
No,
Because when we are
when you are selling, if your date of acquisition of particular stock or mutual fund before 31st January 2018, so you can apply the cost as on 31st January 2018, what is the market value?
So basically, a broker will. So yeah, his question is how you will identify.
It is available, you can get from the
So basically,
website
the
also.
brokers themselves provide the value.
Okay. And other changes from April 2020, earlier dividends were not taxable. Now dividends are taxable in the hands of investors. Earlier dividend distribution tax was there. Then TDS, if you are getting dividend more than 5,000, TDS is applicable. What is the tax planning? Till 2020, many people have invested in a dividend plans. At that time, because which were exempted. But afterwards now, it is taxable. So now you can switch from dividend to growth. But when you are switching from dividend to growth option, it tantamount to transfer as per the income tax act. You have to consider what is the capital gain also. And book profit to the extent of 1.25 crores. Till last year it was 1 lakh, now 1.25 lakhs. This is also one of the best tax planning. Every year, it is applicable for every year till madam changes. See, up to 1,25,000 long-term capital gains are not taxable. It is tax-free. After 1,25,000 taxable. Next. This is simplified complication. Equity shares transferred 23/7. This would have actually postponed to the next year instead of this. So, if it is sold or transferred before 23/7/2024, short-term taxable 15%. After this date, taxable short-term at 20%. Whereas long-term 10% after 1 lakh. If it is sold after before 23/7/24. After 1,25,000 and tax rate is 12.5%. In this year, we will have very good time for capital gains workings.
Software and tech.
And debt mutual funds. Earlier it was 36 months holding period. Now, if it is invested before 1st April 2023 only, it is 24 months. Earlier tax rate was 20% with indexation. Now no indexation and tax rate is 12.5%. And if the investment is after 1/4/2023, all debt funds are taxable at short term, no long term. Thank you very much. Hope the session was fruitful. I thank Manjunath and Bangalore Committee for providing an opportunity.
Any thoughts on financial planning? Because most of the investment and the things we are able to follow.
Yes.
What suggestions you have for the financial
Sir, financial planning is first is we have to set goal. When your goal, like for example, your child age is 10 years and you wanted to perform one medicine, let us assume, that comes after 8 years. It will cost now 1 crore. With the inflation at that time it may be 3 crores. So you have 10 years, your target is 3 crores. Based on that, how much you have to invest, you have to plan like this. See, for each goal you should have a different plan.
Any tools which you would like to suggest to this group which they can put into use?
No tools, you need to sit with financial advisor. First is you have to chart it out, what is your requirement. Then they will suggest. Because without having a goal, investing, like running was, I can go anywhere and get on anywhere, but goal is not fulfilled.
So for example, just building on his point, so while you are saying in terms of reinvesting, but it's the other way around, that we want to advise to our clients.
Yes.
Because now the clients who come for finding the return, they also ask for the advisory from us.
Yes.
And that's where some of the options what we have seen is that for that agency or something which you have to take, that course from SEBI is there.
Yes.
That actually advises you few of the options.
Yes.
Which you have to analyze the data, differential and all those, right?
Yes.
So these are the options which will help you to understand how to analyze. So what you are saying, broker is good, which is what let's say we do through the advisor. But then it's a reverse. Then when we have to do this thing to our clients, so these are the kind of, so possibly we have to go through the course, which will tell us the areas we should be doing.
One is if you have to do mutual fund advisory, you have to, there is a mutual fund distribution exam in NISM, you have to pass, but you cannot practice. Being in a practice, you are not supposed to do. This is one thing. And if you want to have a full information on financial planning, Certified Financial Planner (CFP) is there, but it is a difficult course, and when we are in practice, we cannot devote time on that.
And we don't even get paid for it. Free advice. It's not worth it.
So that's what you can refer to some advisors. You do your work, they will do theirs.
Yeah, so that we can do the sharing with the other advisors.
Sharing also not possible, sir, because in mutual funds hardly they will get 1%. See that time what they devote. Because to be frank, we are also having a separate company for that. We have been running for more than 2 decades. So the fees what we get is not that much. See, we have started for our own investment management. So people came, friends, clients came. Yeah, good.
So investment tips.
Not tips.
Any mutual funds, any mutual recommendation from you?
Madam, it is like, no, you are going to a hotel, give me something which is good. You may give dosa, but you like idli. So first, you should be clear. See, without any goal, investment is dangerous. Because if you are looking for 20 years or 10 years, if I suggest you any investment which is good for next 1 year, then there is no use. So first we should be clear for what purpose we are investing. If we don't have any purpose, the ultimate main thing which is required is retirement planning. So if it is retirement planning, then you go for higher risky funds. And not only that, if you are investing systematically, then you go for higher risk fund. If you are investing lump sum, don't go for such higher risk funds. You can go for large cap funds or multi cap funds. So each time it differs.
So it's basically about analyzing the portfolio which is there in that mutual fund.
Yes.
So depending on it, maybe
yes.
higher risk.
See, not only that, mutual fund distributor, they will have continuously discussions with the fund managers. Like they will meet face to face, Zoom meetings. They will analyze their views also will be there. See, because what we see may be different, what the fund managers see may be different. So they will be foreseeing, they will give their views. Then we will understand that if both are with, then we will choose those funds like that. Otherwise, we have to believe only social media that always misleads us.
So whatever they are asking in the other way around, post-COVID, there are mutual funds which are growing very good. Now, with this current situation, whichever the last 3 years fund is growing, suddenly it has come down.
Yes.
So which are those kind of mutual funds now?
So it is not like that, sir, because if you see since September, market itself fell down by 15%, almost 18% somewhere. It was there 86,000, now it is 74,000. So same mutual funds also fell down by 15 to 18% or 20%. If it is a small cap funds, which are high risk funds, which have fell down by 20 to 25%, because the valuations are very high, very high. So whenever the valuations are very high, a small negative sentiment will yield more negative.
You were showing in the table how they withdraw at the wrong time, 2020,
Yes.
today we have 5 lakhs and 7 lakhs. So any tips for us when we are investing?
See, only single tip is like, if you don't want the funds, don't withdraw it. If you need the funds, then only you should withdraw.
Monitor it, whether we have done correct time withdrawal or not. And
See, investments in a mutual funds, you need not to do continuous withdrawals, first thing. You can only rebalance it, taking from one fund to another fund. That is only based on the market conditions. See, now, for the last 1 year, market was quoting at 60,000. Suddenly it became 86,000. So, what happens? Within 1 year, if the growth is more than 25%, the chances of corrections are very high. And for the last 2 years, if it is not growing anything, chances of growing very fast are very high. So based on that, you should keep rebalancing.
You have done 20% profit in the next 3 years.
Yeah.
But actually,
See, profit booking, there are two reasons why we advise profit booking. One is to take the benefit of that 1,25,000 tax-free income. And I don't advise for profit booking for the short term. Within 1 year, don't do it. If it is more than 1 year only, then you should do it.
the question is, if assuming I could have waited for withdraw at a wrong time,
Yeah.
if I waited for some more 27%, I would have think I would have done withdraw by 20%. But actually 27%
Yes.
have been done.
Yes, that is the reason. Withdrawal, I don't advise to withdraw everything. You have to do it 10% to 20%, not more than that. If you do everything, assuming that market will go down, you withdraw everything or you switch it to the safer investment. But market is master. It will behave however it want. Okay. So after you switch out, it may go up by 10% because there are within 1 week there are chances of going up by 10%. That might happen. That is the reason you should not do entire thing at one shot. You should keep doing 10%. So that even if you do wrong thing, another 90% or 80% will take care of it.
Sir, if a client has surplus but he doesn't have a clear specific goal, where he would lead that in future?
See, if you like this, I am going to bus stand and I want to search which bus I need to go. See, unless I know my goal, where to go, I have to board that bus. If he is like that confusion, he can better invest in debt funds, safer funds. It is alternative to FDs. And one more thing, alternative to FDs, most of the retired people might ask you because they will get only 8% or 7.5%. So which is the best investment for them? You can advise them to put like 25% keep in FDs, balance 75% they can put in balanced advantage fund. What is balanced advantage fund? Like if you are investing 100 rupees, equity component is minimum 65%. Balance 30 or 35% will be in debt. Let us assume 100 rupees is invested today. Out of 100 rupees, 65 equity and 35 debt. Let us assume in 1 week market came down by 10%. So for a simple example, I will take 60-40 ratio instead of 65-35. So 60 rupees will become 54 rupees. 35 rupees will be 35 because there is no market link for that. So what is the total amount? 54 plus 35. So almost 90 rupees. Again that 90 rupees will be divided into 60 and 40 ratio. So it is continuously they keep on doing balanced advantage fund. So that will benefit in a longer term for the people. So for the retired people and who are nearer to retirement, balanced advantage funds are good.
And the balance advantage will be in the range of around 9 to 12%, right?
You can expect around 10% only. See, we suggest normally if it is equity, 12% we advise. 10 to 12%. If it is balance, 8 to 10. If the client gets higher than that, he is happy. But generally, we have to compare. When we are giving any return comparison, we have to compare with FD rate. Based on that, we have to give. Funds may give higher return because if you see last 5 years, which have given almost 25% return. But every time may not happen. If you see last 6 months, minus 20%.
So what should be the ideal portfolio mix for any general person?
See, general person like 100 minus your age should be in equities. For example, your age is 40. 100 minus 40 is 60. That 60 can be invested in equities. Balance 40 can be in a safer investments.
Why you put 100, sir?
So safer investment.
No, it is a general concept.
Like our BP concepts.
End of the day, everybody is learning. Nobody. If I know how to double my money, why should I share?
Yeah, then you can put 100% in equity. You see, since if you are not aware how to and all, see this is like no, because if your age keeps growing, equity should be lesser. That is the concept. So when his age is 40, higher amount can be kept in higher risk. Yes. So when he is at 70, he cannot put in equities.
If you look the other way around, anyway, he has lived his life. He may live for another 3-4 years. What is that? If it comes bumper, if it doesn't come nearer.
There are people, sir. See, there was one investor. He is retired. I know him for 2 decades. he came one day. I advised him. He has asked the advice. I told him balance advantage fund, equity and all. He said, sir, risky no sir, that this and all. And last year he called me, sir, I want to talk to you personally. I said yes, because he stays at KR Puram nearby. I stay at Chambers. Sir, we can discuss over the phone. No, sir, I want personally discuss. He came. Then he was telling, sir, there was some message. I keep invested in this like he keep on investing. He has invested 25 lakhs. His age is 70, and everything gone. And if you want to withdraw, they are asking to deposit another 25 lakhs, another 5 lakhs. So then he went to the police station. He found similar to him 4-5 people. He complained and some amount only he got. See, when I told 8-10% equity, he said it's risky, but he has put 100% risk.
That's his greed.
Yes. That's what we should not be greedy. One of the point,
So any foreign investment options, sir? Maybe like in foreign debt funds and all?
Sir, I don't advise, sir, because if you see in Japan, it was minus debt fund, because now it is just 1% or 0.5% they will give, whereas if it is US, you will get only 2%. So if it is debt, India is the best. You will get, because our inflation is always 5-6%, you will get same interest rate. But debt is only for short term, for 1 year expenses, that's all, not for longer term.
And what thoughts on the REIT?
So REIT, it is very high risk, sir, not advisable. If you have like huge amount in already invested, then you go for those things. I don't advise anything other than mutual funds, because I had my personal investment. I had invested in shares, derivatives, futures, and options till when I had invested my fund 9:30 to 3:30, whatever call attend, I don't know what I have told that time. So it is like an addiction. So I wanted to come out of this. So then what I have decided, if 5,000 is accumulated in my bank account, immediately I have invested in one mutual funds. Even if I tempted to invest, I will not have the funds. So with this practice, I bought office, I bought house, I have a good sizable investment. If I am doing the equity only, I would not have been there probably because of the BP, sugar, all those things. So, anything else?
Just maybe like the last question, you said that 100 minus age is the equity component.
Yes.
So now think of like a 40 age.
Yeah.
So 60 is the equity, the balance 40. Any suggestion how a person, wiser person can split between retirement fund versus insurance versus commodity funds? Some thoughts?
Sir, if he is young, like 40 years, I suggest him put 100% in equity mutual funds, not in shares. If it is 50, he can go 50% to equity mutual funds, 50% to balanced advantage funds. Because if you are aware and if you are continuously monitoring, you can invest more also. But if you are around 6 months ago, one of my friend came. We were hostel mates. He came. He was telling about one investment. What banker has advised. Banker, they went to the banker. Like target, banker called them for investment. They told you invest 5 lakhs per year, 5 years, you will get good return, that and all. So my friend, when he is investing, just like as we casually say, no, sir, my investment should be safe. He said. So after 5 years, 5 lakhs he has invested. So 25 lakhs he invested. He took the money now. Can you imagine how much he got? 31 lakhs. Then when he has asked the bank manager, sir, you said you want to do your money to be safe. No, that's why I kept everything in government banks. So that is the problem. If you don't monitor in between, at the end, after 5 years or 10 years, you have to repent. Unless you monitor when you are investing 5 lakhs, 10 lakhs, 1 crore and all, you frequently have to monitor. You keep discussing with your advisor.
The last question. Majority of the salaried people, by default 24% goes to the PF.
Yes.
Do you think it's a fair coverage for the retirement, or do you suggest they should invest?
Sir, if you remember our slide, DPF versus STFC tax over fund, for 23 years, the difference is 10 times. So, if possibility is there, you reduce the PF because there is an option to limit only to 1,800. If that option is available, please avail that and invest balance amount into equity mutual funds.
So what about cryptocurrency?
Sir, crypto is not like constructing a building on the egg. Will it stand good? Because there is no basis. See, if it is a gold, based on the gold, it will go up. Crypto, there is nothing.
Nowadays we are in greed.
Sir, see, it is like investing and greed. You want to make money, yes, if you are ready.
Now everything is in cloud.
Cloud is different, sir. See, if there is a foundation and safety and security is there, see, who knows who is managing crypto? There were rumors it is managed by the terrorists also. You don't know. Because you cannot trace it, and if something happens, whom you will ask? There is no SEBI, no RBI, no Indian government.
But the growth is very high.
Sir, that's what, see, what is the purpose? If you want to lose some part of the portion, if you are ready, you invest some part, don't invest everything. See, if you are ready to lose 5%, invest 5% of your portfolio there. But I don't advise. Which I cannot see, touch, feel, don't want to invest. Because if it is a shares, I can see the Reliance, Infosys, Wipro, I can see the companies, they are doing good.
We don't say what derivatives and everything. They are also the same thing.
Sir, derivatives is, see,
It's a risk.
sir, investment is different. Derivatives is for greedy. I want to become a millionaire overnight. But you should be ready for losing entire amount.
No, what I mean to say is it's just like crypto.
Yes, yes. But derivative, there is a base. Share is there. See, Infosys share is quoting, let us assume, 1,500 rupees. In derivatives also, either it will quote 1,550, 1,560 or 1,600 or 1,450 also. But it cannot become zero in derivatives. If the Infosys share becomes 1,000 rupees from 1,500, this also will become like that. From 1,550 it may become 1,050 or 950. There is a base here. It is based on the Infosys share. But crypto, there is no base. See, even RBI or government itself, before printing currency, they keep reserves of the gold because some base is there. US is printing money like anything without any base.
Dollar value is not something.
Sir, that is because of so many other political reasons. If everybody decides not to trade in USD, that's it.
Members, that was a fruitful session and fantastic deliberation on the topic investment analysis and financial planning. A big round of applause for CA Professor for adding values. On behalf of members present here and all the managing committee member of Bangalore branch, we would like to hand over a memento as a token of gratitude and respect. Now may I call upon Chairman Sir of Bangalore branch to do the honors. Thank you, Chairman Sir. Thank you one and all. Good night.